Welcome, friends. In this edition of Live Virtual Classes Batch 2, ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all. Students, as we are doing in our previous classes, I hope you must have gone through the lectures on the portfolio management and securitization because CA Divas Gupta sir is with us, who will revise the both topics and will also take up your queries. So, students, you are requested to and discuss your all doubts and queries with CA Devas Gupta sir because whatever doubt is in your mind, please, my request to you, please get them resolved today in the class. Of course, you can also send us a email or you can also contact us over the telephone also. So with this, now I hand over the program to the CA Devas Gupta sir. He will take up the further session. Devas sir.
Sure, sir. Thanks a lot, sir, for the opening remarks. Good morning, students. Today we will start with the topic of portfolio management. So we will start the revisionary part, and then we will also see some of the critical questions that we have done in our previous session. And we will also take up the queries simultaneously. So let's start, students. On the portfolio management, we first of all understood about the two characteristics of a security. One was return and second one was risk. So while we said that return is most, is likely very much similar to what we call as mean in the statistical language, right? Because why we said mean? Because we were given, let's say, two different types of scenarios. One, the historical data in which past, let's say 5 years, 10 years, long-term horizon data is given from which we calculate the historical average, which is called as mean. Or else the second type of data that would have been given is from the futuristic perspective, that what is the probability of getting this much returns. So there will be different probabilities assigned to different observations, and hence we arrive at mean there too. And that was called as return because that is the most expected likelihood of a return. Similarly, on the risk side, we also discussed that in our previous sessions on capital budgeting, advanced capital budgeting, where we understood that risk is called as standard deviation or variance. So here also, standard deviation, as we said, can be computed on two different types of database. One is historical and second one is futuristic. So that we already understand with our previous understanding and knowledge. Now in this, we will elaborate risk more from the different theories perspective. The first is the different breakup of the risk. So the first one is in the macro and micro terms. So macro risk, macro is that part of risk which is present in the entire economy. For all the types of the businesses, this risk is present. And this cannot be eliminated also, students. So this we call as systematic risk in this language parlance. And there are three types of systematic risks. One is the interest rates, because once the interest rates goes up and down, there is a risk that the return from the security, or let's say the price of that security, will move up or down or vice versa. Similarly, market trend. For example, if there is a market trend of market going up, so the entire market goes in that direction, or let's say vice versa. So market trend is also a general risk. Then third is purchasing power, which is inflation. As we all know that in all the economies, there is some inflation that operates. And this inflation impacts the returns of all the instruments that are there in that economy, or of all the companies that are there in the economy. So that hence this is called as macro, or we call it as general, or we call it as systematic. So we'll be using this word systematic later on while we understand the other theory, students. Now, in terms of the micro are such which are very specific to the company. Which are they? One is definitely the business risk. So this is the type of business, or let's say because of the inherent nature of the business, there is a risk, right? Let's say the growth will not be there in the business, which is specific to that company. or let's say the profitability margins are not improving. Similarly, liquidity risk, students. Liquidity risk is where the company is not able to service its debt obligations. For example, whenever interest repayment comes, or so for interest payment comes, or principal repayment comes, that is where the liquidity risk comes into play. So this is broadly what we discussed about risk, broken down into two elements. One is macro and second one is micro, which is systematic and unsystematic, students. Now, we also said that a lot of times we have to compute certain mathematical operations on risk. For example, we have to take a addition, we have to take a subtraction, like that. For example, total risk is equal to systematic plus unsystematic risk, correct? So here the line of thought is we have to always take variance while doing addition or subtraction. We can't take square root of variance, which is standard deviation. We don't have to do any mathematical operation on standard deviation. We always need to do it on variance. And once variance is added or reduced, then we will take a square root to arrive at the standard deviation, students. Okay. So this we will understand in detail later on. Then we understood about these three terms called standard deviation, this one, then variance, and third one was covariance. So standard deviation, students, is actually the deviation within a series of data with respect to its mean. Okay, how much that data is having a deviation from its mean. That is called a standard deviation. Now, variance is actually a square of standard deviation, and covariance is actually once we say that there are two different types of data sets, for example, return of X limited and return of Y limited. So how is X limited varying with response to the Y limited's variation, right? So here we try to put down the formula of covariance of X and Y, where we said that X will be deviated from the X bar, which is its mean, and Y will be deviated from Y bar, which is Y's mean. And we will take a division by N students. Okay. I hope the discussions are clear, students. Then, on the futuristic data, rather than dividing it by n, which is the number of observations, we multiply it with the probability. The formula remains same, correct? So this is called as covariance, in which we try to calculate the variance between two elements. Okay, or let's say the variance between two different series of data. Okay. Now, how it will help? It will help in determining the correlation coefficient. All these things are getting used in our formula, students. Okay, later on, whether it is Markowitz portfolio theory or whether it is Sharpe's index model, it is getting used everywhere. So correlation coefficient, students, is actually referred to the degree of association. Now, what is this degree of association? So it tells us that if X limited moves in a particular direction with particular amount, how will Y limited move, whether in the opposite direction or in the similar direction, and with what amount? Okay. So it ranges from -1 to 1. Okay. So -1 is it's perfectly negatively correlated. That means if the X limited goes up, Y limited goes down with the same extent. Okay. See, it is telling you two things. Coefficient of so correlation coefficient is telling us two things. One is the direction of movement, and second is the extent of movement. Correct? So -1 will mean opposite direction and exactly same amount. Positive one mean same direction and the extent is also very much similar. Zero means it is unrelated. So there is no relationship only. It can move in any direction. Okay. I hope this is clear, students. So this we call something as perfectly negatively correlated. We call it as unrelated. And when R is equal to positive 1, we call it as perfectly positively correlated. So it's a perfect relation because extent is similar, plus 1, and positive is because it is positive in the similar direction. Perfectly negatively correlated is because it is minus 1 students. And in some of the questions, we also were using R square, which was coefficient of determination, students, right? It's just a nomenclature. So coefficient of correlation is equal to R and coefficient of determination is equal to R square, students. Okay. So somewhere in the question, if it is mentioned, so we can make use of this. Now, how is R calculated? Okay. So R, which is coefficient of correlation between two, let's say, data points, which is returns of X limited and returns of Y limited. So the correlation coefficient between returns of both X and Y can be calculated as covariance of X and Y. So first of all, we will take covariance. We have studied above what is the formula of that covariance, divided by standard deviation of X and standard deviation of Y. So if we do this, then we will be able to understand how and in what manner, in what extent the movements will happen. And where is this relevant, students? So is this relevant? And we would have studied, or let's say we would have watched in our recorded session of portfolio management. This is mostly relevant in Markowitz portfolio theory. We will go through that. Okay. And this can be rearranged to derive this equation as well, which is R xy multiplied by standard deviation of y is equal to covariance between x and y, students. Okay. So if let's say out of these four values, any three values are given, we can arrive at the fourth value. Okay. If we are given standard deviation and covariance, we can arrive at x. If we are given, we can arrive at r. If we are given r and standard deviation of x and y, we can arrive at the covariance. Okay. Easy and simple, students. Yeah. So Abrikesh is asking, in case of futuristic formula, only one probability, x and y may have different probability. Yes, it might be possible. But then in that case, you will not have for the same level of possibility, or let's say same level of observation, how will both of them move? Okay. Then you might not be able to do a real relationship between x and y. Because how I can do, if I know that for both of them, 10% is the probability. Now X is moving to, let's say, 5% and Y is moving to 6% with that 10% probability. Okay. So that is where you will be able to calculate Abrikesh. Okay. Yeah. Perfect. Then portfolio. Let's come to portfolio. We have still now studied about a security, right? So like security have two characteristics that we have studied. One is return and second one is risk. Portfolio also will be evaluated in terms of its return and its risk, students. So return is actually very easy. I mean, portfolio return to calculate, it's a very simple step in which we take the return of the individual security and multiply with its weights, and then take a overall summation of all the securities that are there in the portfolio. Now, students, first of all, what is a portfolio? Actually, you're studying about portfolio management. All of us should know what is a portfolio. That's a very basic thing. Yes, Abrikesh is saying bunch of securities. Yes. So it's a collection of certain securities. Yes, different bunch of securities, different securities. You mean, Abrikesh? So, so basically, portfolio is a collection of securities that are scientifically, arranged with the help of certain techniques. That how much our risk objective is, how much our return objective is, and accordingly we derive those portfolios. So Prerna is also saying group of one or more securities. Yes, Prerna, that is true. So when it comes to a portfolio, then for portfolio also we need to see that what is their return and what is the risk. And return, we know that this is the simple formula. Now let's come to risk. Now, this part that we are going to study is actually given under Markowitz portfolio theory, students. Okay. That is called as Markowitz portfolio theory. Why we call it as Markowitz portfolio theory? That we will understand with the differentiating factor once we cover the Sharpe's index model. Then you will be able to make out what is the real difference. So first of all, students, in Markowitz portfolio theory, we talk about how to calculate risk. That also we have bifurcated into two parts just for simplification. One is the two securities portfolio, and second one is the more than two securities portfolio. Okay. The first part is two securities portfolio. Let's elaborate this further. Whenever we talk about two securities portfolio, students, as I said that in my first page where we mentioned that whenever we have to do any operations, let's do it on a variance. So that is where if you see everywhere we use variance. So variance of security 1 multiplied by weight square of security 1. Similarly, weight square of security 2 multiplied by variance of security 2. Correct? So this is respectively weights we have multiplied into their variance. And then we also need to understand that there is a relationship between these two. How? With the help of R or with the help of covariance. So hence our formula becomes 2 W1 W2 standard deviation 1 standard deviation 2 and R1 2. So weight 1 weight 2 standard deviation 1 standard deviation 2 and correlation coefficient of 1 and 2. Okay, students. So weight 1 is equal to weight of security, weight 2 is equal to weight of second security, standard deviation 1, standard deviation 2 is the respective standard deviations, and R12 is the correlation coefficient. Now, if you see this, if R is equal to plus 1, if this term is plus 1, can it be plus 1? Yes. We've just now seen that R can range from -1 to +1. So then it becomes a simple formula of A plus B square, wherein A is equal to weight 1 standard deviation 1 and B is equal to weight 2 standard deviation of 2. Clear, students? Okay, then if R12 is equal to -1, it's a perfectly negatively correlated. So then in that case, A minus B square, it will become minus, right? Because you will substitute R12 as -1 and hence here also it will become minus, right? So it will become A minus B square. Clear, students? Now comes the real, let's say, takeaway from this. Now, what we understood, if R is equal to +1, the risk is getting added. Along with the multiplication in weights, the risk is getting added. If R is equal to -1, the risk is getting reduced, students. And as I say that in portfolio management, What are the two objectives, students? So the objective is to increase the risk or reduce the risk. And the second objective is to increase the return or reduce the return. Definitely, our objective is to reduce the risk and increase the return. If R12 is equal to -1, then only A minus B raised to the power 2 will give you a lower risk, students, compared to what individual securities have. Correct. So the bottom line is that whenever the correlation coefficient becomes -1 or between two securities it is -1, then your risk is very limited, or the risk will become negligible. I hope this is clear, students. Then we will move to the third part, which is more than two securities. Okay, so portfolio risk, as per Markowitz portfolio theory, can be computed using these simple formulas for a two security portfolio. Now let's come to more than two securities portfolio. So here, students, in case of more than two securities portfolio, let's take an example of three, because the same matrix can be used for more than three as well. Okay, so we have taken three securities, A, B, and C. A, B, and C. The respective weights are weight 1, weight 2, and weight 3. So whenever it comes, students, we have to do a proper matrix. Okay, the matrix in the form rows and columns. And then we will have to start put our values. So let's say first row, first column is this. One by one, I'm saying, okay. One is column and one is row. So which is here, it will be W1 into A. And again, from the column, we will pick W1 into A. And we will also take R of A and A. So what is R of A and A, students? What is the correlation coefficient within the same? It is always going to be 1. Yes, same. So RAA, we can take it as 1. Then what about the 2 by 1? 2 by 1 here is, I mean, second column and first row. A column is like this and row is like this. So here it will be weight 1 of multiplied by A, standard deviation A, and here from column we will take weight 2 into standard deviation of B, and then R of A and B, students. Simple. So simply what we have to do, wherever we are in that matrix, we have to just take that rows, weights, and standard deviation, columns, weights, and standard deviation, and multiply it with the correlation coefficient between both of them. Okay. So similarly, like this, which is 3 by 1. Here also it is 1 by 2, 2 by 2, and 3 by 2. So third row and second column. Here it will become 1 by 3, 2 by 3, and 3 by 3. So likewise, we calculate for all these 9 values, right? And take a all summation. We take horizontal also take summation and then vertical take. So all the 9 values put together, you have to take a sum. Whatever you arrive at, that is called as the variance for the portfolio, students. So Abrikesh is asking, in exam, value of R will be given or we have to calculate? No, Abrikesh. As we discussed here, R is having a relationship with covariance X and Y and standard deviation of X and standard deviation of Y. Okay. And hence we will have to use this equation to calculate R. R will not be given. So R is not something like a normal distribution or any other thing. It's just simply a value from this equation, students. Okay. And if let's say the question will warrant that, sometimes they might give you as well. But if they are not giving, then you will have to make use of this information. Okay, students, let's move ahead. Okay, so these are the cases for more than two securities. We have discussed specifically for three securities here. Now let's move ahead. We will come back to questions. Let's first cover up the concepts. Yeah, so this is also an interesting thing. Whenever we talk about a return, okay, so how do you calculate a return of a equity share? It's very simple, right? You have two things. The way you get a return on an equity share is basis two things. One is the price appreciation, and second one is the dividend. So what we do is we take the closing price, we add dividend to it, and we reduce the opening price to arrive at the return, divided by the opening price to arrive at the return percentage, students. Yes. Now let's come to another interesting discussion, which is a systematic and unsystematic risk, students. Okay. Now, as per our first or second, I think, slide discussion, we discussed that risk has two elements. I think that was the first slide, macro and micro. Macro is the systematic one, and micro is the unsystematic one. Now, we introduced an element called beta. Okay. Beta is a measure that helps in assessing the systematic risk. So, for example, you know that there are, so for example, there is a market. By market, I mean entire economy put together. Let's say all the shares of the companies that are operating in an economy put together, which is as good as a Bombay Stock Exchange or a National Stock Exchange or any other recognized stock exchange now on a national basis. Then you have different equity shares trading on those stock exchanges. Let's take an example of any X Limited. So beta, what we say is actually a sensitivity of returns of that X Limited in relation to that of the market. So if let's say the market is moving in any direction, how will X Limited move in response to that? That is called as beta. Now, beta, so we understood that beta is basically the sensitivity. Now, what we also understand is the systematic risk, students. Systematic risk is that of the market put together, right? Or let's say the macro level. So if we help to know, if we get to know that what is the overall risk in the market, using beta, can we also derive that what is the systematic risk component within that X Limited? The answer is yes. Correct. So beta is basically used to calculate the systematic risk because it always bears the relationship of X Limited with that of the market, students. Now, there are two ways to calculate beta. Let's first understand how to calculate beta. So there are two ways. One is the correlation technique and second one is the regression technique. So in correlation, we make use of R, which is correlation coefficient. So if X Limited increase, market will also increase. But sorry, or I can say if market increases, X Limited also increases. So to what extent and exactly in the same degree, that is given by R, right? So we have to calculate R for that, which is R of X and M. So X here is the security which is getting traded and M is the market. multiplied by the standard deviation of X divided by the standard deviation of market. If we do this, then we arrive at beta. Okay, students, beta is clear from the correlation point of view. So correlation point of view, it tries to establish the relationship between X limited and market using R and hence arrive at beta. Now, regression technique, students, is somewhat different. Regression technique, it assumes one factor to be independent and another factor to be dependent. So in this case, market is independent and X limited is dependent. Market moves in any direction. In response to that, X limited will move depending on where the market moves and how much the market moves. So here the beta is given by this formula. What is this? Summation of xy minus xy means the x. The x is what? X is that stock that we are talking about. And y is what? Y is the market. So for that stock, what is the return? For that market, what is the return? Multiplying and adding it minus n is the number of observations. How much number of observations we are talking about? Multiplied by the mean of stock returns, which is x bar, and mean of the market returns, which is the y bar. Then divided by summation of y square minus n y bar square, students. So Abrikesh is saying in real life, both going hand to hand is not seen always. Example, current sensex volatility. Yes, but to some extent, over a period of time, let's say we have a valid observations of last 5 to 10 years. So with that, we can definitely calculate and predict that what is the right beta. Also, although beta also keeps on changing, right? It's not that beta if calculated today, it will remain same. It's not like that. It's also a variable from that perspective, okay? But since we have to restrict our discussion, and hence we are saying that we will use either of these two techniques. One is correlation and second one is regression. Now, this is a very important graph, students. So this on the x-axis has number of securities, and we say that on this x-axis, the number of securities are starting from 1, 2, 3. So let's say we have 3 securities put together here. We have 4 securities put together in a portfolio, okay? Like that. Then, like, let's say there is a portfolio with very large number of securities that will be towards the extreme right, correct? This side. And on the y-axis, we have standard deviation. Okay, what is the standard deviation for those respective number of securities, students? If we plot it, we will get something this kind of a curve that is mentioned here, right? Like this. This is the curve. The reason being, why we say that if there is a single security, higher risk. That is true, right? We always understand. If you invest everything in a single security, now you are running a higher risk. If you create a portfolio of securities, it might be possible that if one security is underperforming, the second security might overperform, and hence your overall return remains intact. And students, we also understood risk has two components. One is the systematic and unsystematic. And as I said that systematic is something which is omnipresent, which is present generally in the economy that cannot be acted upon. However, unsystematic risk can be brought down. So here we are saying that unsystematic risk will become lower. As and when you move to the higher number of securities, your unsystematic risk becomes lower, students. Clear? And that is why we say that what is the process of diversification? The process of diversification is this only, where you increase the number of securities to make sure your unsystematic risk comes down. And only thing that remains at a point of time is the systematic risk. Okay, students, clear? Yeah, perfect. Now let's move ahead. Okay, now questions again I'm skipping as of now. We will see. Then we, yes, came to Sharpe's index model. This is a very, very important and interesting concept. So this is in contrast to what we have discussed in the Markowitz portfolio theory. So it says that how you track X limited in response to market, that we track using beta, right? So it says that, okay, let's try to see how we can arrive at the return and risk of a security from a market point of view. So now securities return was also divided into two parts. One is the macro and second one is the micro. So macro is something related to the market that everyone gets, which is the return of the market. So RM is actually the return of market. But that return is specific to the market, not to the security, and hence we have multiplied it with beta. So that helps in telling us that if tomorrow the market return goes, from 10% to 15%, so in similar range, the securities return will also go, but adjusting for the beta, because beta is really the yardstick between the securities return and the market return. Understood? Then on the micro bit, mm, now micro has also two more components. One is alpha, and second one is the return on the residual risk, or let's say unsystematic risk. Now, what happens, students? See, if there is an investor will definitely ask for this much of return, saying that this market linked return is this much. Now, you also tell me tomorrow if the market return goes down, still I should need some return, right? So, this is that alpha, which is the minimum return expected. Even if the market return is zero, still I would want this alpha. Correct? That is how the investor thinks. And third one is actually because that investor is saying, I am going to undertake the unsystematic risk. And hence I need to know what is the return on account of that unsystematic risk. Okay, students. So this is the equation. Return of security is equal to alpha plus beta RM plus return on the unsystematic risk. Clear? So if you see, Sharpe's index model has categorized returns also into two parts, macro and micro, and accordingly they have been used to calculate the return. Now let's come to risk. The risk is here. Now similar way we have risk also into two parts. One is the systematic and second one is the unsystematic. Now systematic is something which is again macro and unsystematic is micro. So the way beta into return of market is the macro return. Similarly, beta square into variance of market will become the macro risk. And in case of a micro, the residual risk will be denoted by the standard deviation EI raised to the power 2. Because micro also there will be some risk element that is left. Now, students, if you see here, the systematic risk is given what? This is the systematic risk. This is the systematic risk, and this is the systematic risk. Clear? Some people say that systematic risk is beta, but please make sure we are not using that because systematic risk is not beta. Beta helps in calculating the systematic risk, which is beta square into the standard deviation of market square. And hence, the variance is actually this, right? The standard deviation of the portfolio will become square root of the variance, which is beta square, standard deviation of market square, plus unsystematic risk variance. If we take a square root of that, we will arrive at the standard deviation of A students. Clear? By A here, we mean the security. We're talking about security first, right? This is the risk of security. Clear? So in this case, what we have done, how we have calculated the risk. The risk we have broken down into macro and micro, and accordingly we have taken the different values, students. Sorry. Okay. Now let's come to the portfolio risk and portfolio return, students. This is again as per the single index model, or let's say Sharpe's index model. Let's talk about the return first. How will you calculate a return under the Sharpe's index model? Simple. We know that what is a security return. Security return is this. Multiply it with the respective weight to arrive at the risk of the return of the portfolio. Correct? So let's say there are 10 different securities and there are different weights assigned to those securities. We will arrive at the return of that entire portfolio. Correct? By taking a summation. Risk part. Now, risk part is very easy to calculate here because in Markowitz portfolio theory, whether it is two securities, more than two securities, let's say 4, 5, 6, how much ever securities are there, you will have to do the calculation using a matrix. And that will involve lot of additions, lot of calculations. However, here if you see, this formula is actually similar for any number of securities. So for example, you have, let's say, assume in this case, you have 5 different securities in a portfolio. Okay. So what you will do, first of all, you will just simply take the respective betas, multiply it with the weights, everything at a square level, because we will do everything at a variance level. Okay. And multiply it with the variance of the market. This will give us the systematic risk of the portfolio. This entire part will give us the systematic risk of the portfolio, students. Clear? And let me tell you, in beta, the interrelationship between two securities is not used. The relationship of that security with the market is used. Correct? That is where beta is. And the next part is the unsystematic risk of the portfolio is actually denoted by whatever unsystematic risk you have, multiplying it with the weights. Then we arrive at the unsystematic risk of the portfolio, students. Clear, students? So in a way, the portfolio risk under Sharpe index model is relatively very easy and very simple because we use only one index. That is the market returns. Correct? And hence we call it as single index model. I hope it is clear. Now let's draw out a difference between Markowitz portfolio theory and Sharpe's index model, which is this. So Markowitz portfolio theory, we make use of covariance between A and B. What is A and B here? Different types of securities. And using that, we calculate the correlation coefficient of A and B. And the third thing is we also make use of the matrix approach that we have already discussed. On the other hand, for Sharpe's index model, it is very easy because we only need to have these two things. One is the standard deviation of the unsystematic part, right, which is the residual risk. And second one is the beta. Okay. Now, actually, we tried to understand. Okay, let me just draw out. Let's talk about Markowitz.
Divas, can I intervene?
Yes, sir. Sure, sir. Good
If
morning,
we
sir.
can,
Good
good
morning.
morning. Good morning. If we can focus on concepts and, in every lecture, 15 minutes or half an hour, we summarize the whole paper, whole subject, how easy it is to understand concept, make acronyms. So that should be more important than solving a problem and going into detail. This is one subject which students feel it is a difficult subject. So first we have to erase that impression.
Sure, sir.
And आशीष जी तीन स्टूडेंट यार क्या हम लोग कर रहे हैं, बार बार बोलते हैं फ्लायर बनाओ, पब्लिसाइज करो, हर वीक मेलिंग करो। 9 लाख हमारे स्टूडेंट्स हैं,
Okay,
बहुत
sir.
अचरज होता है।
Yes, sir.
एक क्लास का 50,000 रुपया हमारा खर्च हो जाता है। हम लोग कितने कॉस्ट कॉन्शियस हैं, कितने यूटिलिटी ऑफ द एक्सपेंडिचर है। दिवस, we wanted model papers, we wanted short notes. Nothing is coming from you.
Sir, soft notes, I'm preparing on them. Sir, I will share them.
So whatever you have made till now, please share with us now
Sure,
only,
sir.
today. And model papers also you make. We wanted 10 model papers. आशीष जी जरा कोऑर्डिनेट करो ना सबसे।
Yes, sir. Okay, sir.
We don't want lecture like for 3 students. उनके पास इतने पेन ड्राइव है, इतने यूट्यूब वीडियो लेक्चर्स हैं। कैरी ऑन दिवस जी, कैरी ऑन।
Okay, sure, sir. So, yes, students, we were discussing on the differences in the Markowitz portfolio theory and Sharpe index model. So, as I said that in Markowitz portfolio theory, let's assume there are, let's say A, B, C, D, and E, right? These are the 5 different securities that are there in the portfolio. So for this, we will have to calculate the relationship of A with B, then B with C, C with D, D with E, and similarly A with C, C with E, and whatever permutations and combinations are possible for all of them, we will have to calculate the respective relationships, right? However, on the Sharpe's index model, everything is linked to the market. A, B, C, D, and E will be linked to the market. So we only have one relationship here. Everything is related to the market. A related to the market, B, C, D, and E, right? So that is why it is called as the single index model, students. Okay, then let's move ahead. What else we discussed earlier? Yes. Now let's come to CAPM, which is the capital asset pricing model, student. This is very relatively an easier, aspect, wherein we said that the return of a security is actually a combination of two things. One is the risk-free rate of return plus beta into RM minus RF, right? So this is the risk premium that is there over and above the risk-free rate, right? And we multiply it with beta because whatever beta is, that will help in, sorry, whatever beta is, that will be adjusted into the risk premium to arrive at the security related risk premium. Okay. And we also call this equation as the security market line, students. We will discuss about the capital market line and security market line in the next slides. Then, as we know that return, because of the above formula, becomes into two parts. One is the risk-free return and second one is the risk-adjusted return, students. Perfect. So students, till now, if you see, let me summarize quickly what we have discussed till now. One is we have discussed about the risk and return related calculations for a security as well as a portfolio. We have discussed about two different theories. One is the Markowitz portfolio theory and second one is the Sharpe's index model. Now, let's try to understand how do we really evaluate a portfolio, right? Once the portfolio is formed, what are those key performance indicators or what are those specific things that we want to track? So there are two, parts to that. One is the Sharpe's ratio and second one is the Trenner's ratio. So using these two ratios, we can still evaluate whether the portfolio is performing well or not. So the first part is Sharpe's ratio. Sharpe's ratio is actually the excess return over the risk-free return. So that is called as the return of the portfolio minus risk-free rate. Correct? This we call as excess return of that portfolio. And we divided it by the standard deviation for the portfolio. So we call it as excess return for 1 unit of risk, students. Second one, Trenner's ratio. Trenner's ratio is actually the excess returns for 1 unit of beta. So here you see, instead of standard deviation, beta is used. Okay. Perfect. So now, students, really, what is the difference between a standard deviation and beta? So with our previous understanding, we understand that standard deviation is actually the holistic risk, is the total risk, right? And beta is only representing the systematic risk. Although it's not equal to systematic risk, but it is representing the systematic risk. Correct. So both these ratios, higher it is, better it is. Because for 1 unit of risk, if I am getting a excess return which is much higher in a portfolio, I will prefer that portfolio compared to another portfolio where the excess return is lower for 1 unit of the risk. Similarly, it goes with the Trenner's ratio, students. Then let's come to the Jensen's alpha. So in Jensen's alpha, we calculate actually the actual return vis-a-vis the expected return. Okay. So expected return is something that we would have expected basis our CAPM or basis our beta, basis the risk premium. What should be our expected return look like? However, actually, whatever we are getting will make a difference. Now, for example, we took three different cases here. We said that the actual return and expected return. If let's say actual return is 10% and expected return was 8%. Come on, tell me, students, what will you do? So if the actual return is higher than the expected return, I'm just putting it over here. Actual return is higher than the expected return. So Abrikesh is saying sell. I request everyone also to answer, please, who are there, who have joined. So if I say that actual return is actually higher than the expected return, then what will be our course of action, students? See, I expected to get 8%, but actually I'm getting 10%. So should I buy it? Should I sell it or should I hold it? I should buy it. Okay, I should not sell it. Why should I sell it? If the moment I sell it, I will lose the opportunity to make the higher return. Okay, Brikesh. Now, in the second case, where my actual return is lesser than expected return. So, if my actual return is lesser than expected return, what I will do? I will sell because I'm not getting my expected return from the security, right? Then, lastly, if it is same, then I will hold, right? Actual return is equal to expected return. I will hold on to that investment. Okay. Then let's come to the concept of capital market line and securities market line, students. So the capital market line is actually denoted by a graph wherein x-axis has a standard deviation of the market and y-axis has the return. Similarly, securities market line, everything is same except the x-axis has beta, right? Instead of the standard deviation in the case of capital market line. Okay. So what we say, capital market line is actually what is the return at each and every standard deviation. If we plot that, we get this graph. And similarly in securities market line, what is my return for each and every beta? If I plot that, I will get a securities market line. Now students, if you see, the way it is denoted is the return of portfolio is equal to the risk-free rate of return plus excess return, which is RM minus RF, divided by the market portfolio, the market portfolio standard deviation multiplied by the standard deviation of portfolio, students. Okay. I'm just simplifying it. So students, we have to remember only two things here. Okay. One is, if you see this, if you see only this box part, RM minus RF divided by standard deviation of M, right? So then what it is a Sharpe's ratio, right? Don't you think it's a Sharpe's ratio? So can we say that the slope of CML is equal to the Sharpe's ratio of the market? So capital market line, because this is a Sharpe's ratio of market, right? So students, since portfolio has a for portfolio, we can calculate a Sharpe's ratio or Trenner's ratio. Similarly, for the market, also we can calculate the Sharpe's ratio and Trenner's ratio, students. Okay. Agreed. So hence, if you see this is the Sharpe's ratio for the market, which is called as the slope for the capital market line. And slope of the securities market line is equal to the Trenner's ratio, student, because we make use of beta here. As we would have discussed in detail about all this in the recorded lectures, right? Here we talk about the beta here. And hence it's a Trenner's ratio, students. Okay, so sometimes if the let's say the question says that um, the slope of capital market line is this much. So please understand the question is talking about the Sharpe's ratio of the market. Or sometimes if it says that the slope of securities market line, then understand they're talking about the Trenner's ratio of the market. And hence we can make use of them to calculate or recalculate some of the missing parts in the question. Just a second. Okay, so let's come to the next part, students. Students, towards the end of the session, we will also cover some of the MCQs, which I want all of you to please answer. If there are any questions, please do let us know. We have not been receiving much questions. Um, Still, if there are some doubts, please do let us know, students. Yes. So, students, now let's understand about two things. On the risk part, systematic, unsystematic, and we said that beta is where we use to calculate the systematic risk. Now, as I said that in that one chart that I've shown, wherein the unsystematic risk is called as a diversifiable risk, okay, which can be diversified because only this risk can come down, students, nothing else, okay. Systematic risk will still be there in the economy, right? It will have to continue. And we discussed about what we said in two portfolios, two securities portfolio. If R is +1, R is -1. If R is +1, that means perfectly positively correlated. Then it becomes this. And if R is -1, then it becomes A minus B raised to the power 2, students. Okay. So whenever we have something in our mind that, where it is that we can reduce the unsystematic risk, we have to find for those securities which has a negative relationship, or let's say R is equal to minus some points up to -1, we will have to make use of that. Now, students, this is a Markowitz portfolio theory related graph which shows the efficient frontier. We put risk on x-axis and return on y-axis. And for all the risk and return combinations, we plot the graph and we get some line in this manner, which is called as the efficient portfolio. Like here. Okay. This is called as the efficient portfolio. Why we call this as an efficient portfolio? Because any portfolio you take on this line or on this frontier, it will have the highest return and lowest risk combination. No other portfolio will give you a higher return for the same risk or a lower return for the same, sorry, or a same return for the lower risk. Okay, that is why this is called as the efficient portfolio. And the capital market line, if we put a capital market line also, wherever these capital market line meets with the efficient portfolio, that is called as a market portfolio, students. Okay. Yes, this was another thing which we said that in capital asset pricing model, beta is used. And what is beta? Beta is the sensitivity of the changes in the security return in relation to that of the market, right? Now, beta and company beta in relation to GDP is 1.5 and in relation to inflation is 2. Now, this also can be used. That is called as arbitrage pricing theory. Because in capital asset pricing model, what we used is beta for the market returns, students, right? But similarly, beta can also be used in the form of GDP or inflation. That is called as arbitrage pricing theory, in which all the different factors will have their respective betas and their respective premiums. Right? What are those different factors, students? One, it can be GDP. Second, it can be inflation. Likewise. Okay. Now let's do some of the critical questions, students. I'm just taking question number 4. I have noted some of the questions which I feel are critical to discuss. We will be discussing them. Yes, students. Question number 4. Mr. X is having 1 lakh shares of Messrs. Kanakya Limited. The beta of the company is 1.4. Mr. Y, a financial advisor, has suggested having the following portfolios. So already Mr. X is holding one equity share and Mr. Y is suggesting to hold these much of equity shares. A revised holding, as a revised holding basis, market return is this much, risk-free rate is this much. You are required to calculate the following for the present investment and suggested portfolio. What is the expected return based on CAPM, and also if the market goes up by 2.5, goes down by 2.5, and gives a negative return of 2.5, students. That is more important. And thirdly, if the probability of the secondly, if the probability of the market giving negative return is more, please advise Mr. X whether to continue the holdings of Mrs. Kanka Limited or to buy the portfolio as suggestion by Mr. Y. If so, why? So, students, if you see, we have been given respective betas of the respective companies along with their holding percentages, right? So, we have 4 different securities, SKPD, and we have their respective betas. Percentage holdings also we have. We arrive at the weighted beta, first of all, right? So by multiplying this percentage holding with the beta, we arrive at the weighted beta, students. So the portfolio beta becomes 1.015. Okay. Then, since we have the portfolio beta, can we calculate the portfolio return? Yes. So students, we need to calculate both for Kanakya and portfolio. 8% is the risk-free rate of return that is given in the question. Beta is also there, 1.4 and 1.015. If you see, beta of Kanakya Limited is 1.4, and for portfolio we have calculated in this step. Market return is 12 and risk premium is 4 and 4. Correct? So the beta multiplied by the risk, which is the risk premium for that particular Kanakya or portfolio, is this much, which is 5.6 and 4.06. And hence the expected return will become 12.6 and 13.6 and 12.06, students. Okay. So simply what we have done, we have actually tried to find the missing link of portfolio beta to arrive at the portfolio return as well as Kanakya returns. Then if the market goes up by 2.5%, students, then what we will have to do? For Kanakya, earlier 12% was there. Sorry, now it will become 14.5%, students. Minus 8, this becomes 17.10. Similarly, for portfolio, this becomes 14.60, students. Okay, so Kanakya is in. So if you see, with a 2.5% increase. Kanaka has increased more compared to the portfolio. What is the reason, students? Come on, tell me. Can you say why the return of Kanaka Limited is higher compared to the portfolio return for the same increase in the market return? Can anyone tell me what would be the reason, students? Come on, just think and then tell. My question is that in this case, for the same market increase, Kanka is giving you a better return. Yes, students, tell me please. Yes, perfect. Prerna, you are right. Abrikesh, you are right. It's because of beta. Because of beta, students. Then second one, in case of market goes down, then also 1.4 and 1.05. So here it was 12 minus 2.5%. Then market return, if it is negative 2.5, then we will just simply replace 12 by negative 2.5. And we will arrive at the negative returns. Definitely the returns are going to be negative, right? Only risk-free return is positive, rest risk premium will become negative. Now the second part, which was more critical, it says that if the probability of market giving negative returns is more, then we advise Mr. X to buy the portfolio suggested by Mr. Y because beta of the portfolio is less than that of the Kanakya Limited. So it is advisable to go ahead with the portfolio because see ultimately if we have better beta, if we have higher beta, we will advise you to invest in case we expect that the market is going to go up. In case we know that market is negative or it is going to go down, then we will definitely ask you to invest in a lower beta investment so that the risk is minimal. Okay, students. So I think let's take a break of 10 minutes, students. We'll again reconvene at 8:23 times. Okay. Thank you. So yes, students, welcome back. Let's start with a discussion on securitization now. Portfolio, we will see once if let's say other queries come, then I will take it up. But otherwise, I think we are good to go on securitization. Then we will come to some of the MCQs. So students on securitization, yes. So what is securitization, students? First of all, securitization is something wherein we try to convert the illiquid asset into a marketable securities. So here we have taken an example. Let's say Mr. A takes a housing loan, okay, from bank. And in return, Mr. A promises to repay the principal as well as the interest in the form of EMIs to the bank. And bank grants a loan to Mr. A. Now, if we see in the balance sheet of the bank, what are there in the different components of the liabilities and equities, and what are there in the different components of the assets? Yes, Prerna, you're right. Securities with underlying assets. That is called as the securitization. Very good. So, what are the different components in an equities and liability? Equities, let's say 1 lakh. Deposits, whatever deposits that general public give to the bank is also appearing in the liability side of the bank, right? In the form of the savings, in the form of the fixed deposits, recurring deposits, anything. Okay. And let's say the bank has also borrowed money around 50K. On the right hand side of the balance sheet in assets, we have housing loans given to the different individuals, right? Now let's focus on this chart, students. Let's assume Mr. A takes a loan of rupees 1 lakh from the bank. And now the bank will keep on receiving the principal and interest. But the bank's earning capability is only limited to the loan given by the bank to Mr. A, right? Which is rupees 1 lakh. What if bank wants to give further loan with the same amount of capital? The bank does not want to increase the capital. Neither it also not want to increase its borrowings. Then what will bank do? Bank will sell this asset. Okay. Bank will sell the asset. To whom? To some of the SPV. SPV which is formed for the purpose of this purpose. Right? So bank will transfer, or let's say the sell the loan to SPV. SPV will give 1 lakh to the bank. Bank will use that another 1 lakh to give another loan to Mr. B. Right? And similarly, Mr. B's loan also bank will take and sell it to SPV, again realize and then give it to Mr. C, something like that. So if we see bank has taken this illiquid asset. Why this is an illiquid asset, students? Because the term of the repayment of these loans generally is 15 years to 25 years, right? That is where you're expected to return the money to the bank. And hence, these are called as the illiquid assets for the bank. Now, what has bank done? Bank has sold these illiquid assets to an SPV. And SPV pays to the bank rupees 1 lakh, right? Here, bank is also called as an originator. Mr. A, Mr. B, Mr. C, like this. These are called as the borrowers. So we will take the bundle of them. These are called as the borrowers, student, right? And the way it is done is that for all the loans that are given, all of them will be combined into a bundle and different categories will be made, right? And then they will be sold to SPVs. Now, what is SPV? SPV is a special purpose vehicle which can be in the form of a trust, which is enacted to take over these loans from the banks. And what SPVs done do in turn is that they will create smaller securities for these loans that has been purchased from the bank, and these securities will be given to some of the investors. These investors are in the form of pension funds, high net worth individual mutual funds, and institutional investor students, where they have good amount of money to invest in. So they will purchase these securities from SPVs and they will invest in SPV. SPV will use that investment to purchase the assets from the bank. Okay. And these SPV will sell the denominations into multiple units, 100 units into 1,000 each. For example, that is where 1 lakh will be arrived, because it will create smaller units in the form of that denomination. Okay. Now, in the entire process, what has SPV done? SPV has broken up the entire amount into securities, students. That is called as securitization of the home loan. And as I said that, converting the illiquid assets to marketable securities, students. Illiquid asset is something which is a home loan, which has a tenure of, let's say, 25 years. And marketable securities is this units that has been issued to the respective investors, and they can sell, purchase those units, right? That's why it is called as a marketable securities. Now, home loan students, we know that these are called as the mortgage loans because home is kept as security. Correct? Home there is kept as a security. That is why we call them as a mortgage loan, because mortgage is something backed by a security of a home. That is called as a mortgage. Now, if bank is selling loan to the SPV, what is this loan means? Loan means the right to receive the interest and principal, right? Bank is selling that right to receive the interest and principal to SPV. And in turn, SPV will receive the interest and principal, students. True? Now, as I said that illiquid assets is actually a pool of assets that is converted into marketable securities. And now let's say other mathematics will come into play, where we will say that out of these 10 crore, let's say, asset value, which comprises of 1,000 borrowers. Let's take an example of 1,000 borrowers. And to them, we have given 10 crores, right? So 20% of the borrowers will default. If let's say that is the probability, basis their credit, status, basis a lot of things, we know that 20% of the borrowers will default. So multiplying that with the 50% amount, okay. So 20% of the borrowers will default on the 50% of the payments. Sorry. So effectively, 10% of my entire loan amount becomes not receivable, which is 1 crore. Okay. Now, whom do you think, students, whom do you think will bear this loss? Either SPV will bear the loss or bank will bear the loss. Come on, students, tell me. So the question is that in case there is a probability of default, okay, sorry, around 1 crore is the probability of default, students. Who will bear this loss? Whether the bank will bear or whether SPV will bear the loss. Sorry. So Prerna is saying both. Prerna is saying bank. Abrikesh is saying SPV. And Munish is saying SPV. Okay. So students, let me tell you, there are two types of arrangements here. Okay. One is a recourse basis and second one is a non-recourse basis. So recourse basis is something where SPV have an option to fall back on bank if the amount is lost in terms of the PDD. I mean, probability of default, right? In non-recourse basis, SPV will not be able to recover it back from the bank. There is no entitlement to the SPV to get funds back from the originator. Okay. So it depends on what is the arrangement type, if it is on recourse basis or on non-recourse basis, students. So Abrikesh is asking in practice which option? It can be both, Abrikesh. It can be even a recourse basis. It can be even a non-recourse basis. The only thing is on a recourse basis, the SPV will enjoy a lower commission. And on a non-recourse basis, SPV will enjoy a higher commission, right? The income of SPV will be higher. Clear? Let's move ahead. Now let's come to the borrower. And let's say, okay, now let's come to the relationship between originator and SPV more, right? And let's introduce the other parties also. So we have originator, which is the bank, which has actually got the things securitized, which has got the loan securitized, that is called as originator. There is a borrower and the originator is selling the loan to SPV, students. I am talking about here. Okay, the moment it happens, as I told you that SPV is mostly, enacted in the form of a trust. If there is a trust, there will be trustees. If there is a trust, there will be trustees. Why it is in the form of a trust? Because it is holding money on behalf of investors to invest, right? And then these investors will invest in this trust, wherein they will be issued some securities. Now, for investors to invest in trust, they need some form of a assurance that the assets which SPV is going to purchase from the bank are actually good. And the default, if anything, is within the limits and it is also known. So credit rating agencies will help in that process. So they will evaluate the pool of assets of SPV. So there are a lot of credit rating agency students, and this is a very critical step, I can tell you. Because if the credit rating goes for a toss, then investors will suffer, SPV will suffer, even originator will suffer. Okay. So this is a very important point. Then, if let's say credit rating agencies evaluate and concludes that the rating of these assets which SPV is planning to invest or has already invested is really good. Okay, so they say that the credit rating is very, very good. Then what is SPV going to do? SPV will say that, see, I hold the pool of assets which is very, very high in terms of the credit worthiness. So I will give you lower returns because the risk of default is lower. You're getting the point? That's how they will think. And in case of higher risk, they will tend to have higher returns. Okay. So if it is a credit rated, it would increase the investors' confidence, students. If it is not credit rated, then investors will also feel that why should we invest? And there are different forms of this credit rating. Let's say triple A, double A plus, like that. Triple B, BB plus. Okay. So your cost of borrowing also depends on the credit rating. You have a higher credit rating, your cost of borrowing will be lower, right? People will be willing to invest within you within a lower return expectation if you have a higher credit rating. Okay, students. Okay, so let's continue, students. Any questions till now? Okay, let's come down. Yeah, so this is a comparison between the bills of exchange and securitization. So bills of exchange, students, happens on a transaction to transaction level, right? If I have sold some goods on a credit basis, I can get that bill exchanged, right? And get the receivables liquidated. On a securitization basis, it happens on a pool of funds. And it happens through securities being raised, amount being raised from the securities, right? But bills of exchange, it is just simply going to a bank, converting my receivables into cash. Now, these credit ratings are basis the interest rate or return percentages, students. True? Because they will impact the interest rate or the returns percentages. Yes. Yes, it is same as bill discounting, because in bill discounting, only thing is you will end up paying some of the commission or the charges, Abrikesh. Now, the next thing is on this chart, we will introduce some other parties. Okay. So if we see borrowers, we already know these are our first and foremost parties. Originator are the banks. SPVs also we understood. Trustees are there because this SPV is actually held by in a trust form, and hence we will have trustees. Then investors were also known. Credit rating agencies also we discussed what are their functions, because good credit rating agencies, good credit rating and bad credit rating will impact the return percentages, students. Correct. Now, if you think practically, there are, as I said, that there are thousands of borrowers. Now, those thousands of borrowers have contracted with the bank to repay the amounts. So they will continue to repay back to the bank. And hence, the SPV will need some form of a party who will administer those receipts, and hence they will release the payment to SPVs. So hence, SPV will say that SPV will say to the originator, hey, we need to appoint some sort of a receiving and paying agent. And this receiving and paying agent will have a responsibility to receive the amount from the borrower, check it, maintain the ledger of books of accounts, make sure that the payment is receiving on time and hence remitted back to the respective SPV. Okay. So this is the role of receiving and paying agent. This is F. Okay, they pay to SPV. Now, students, we understand these are called as the mortgage-backed securities. Mortgage-backed securities are such securities which has an underlying as a mortgage loan. So, if you see the securities that are issued to the investors, these 1,000 securities at the rate of 10 each, whatever is the value, that is called as the mortgage-backed securities because these securities are issued by the SPVs to the investors. SPV is holding those mortgage loans, which has been originated by the bank to the respective borrowers. Correct? So hence, we understand the term called mortgage-backed securities. Now, students, if the risk is lower, the return is also lower to the investor, students. That we have clearly identified and understood. If the risk is high, the return to the investors also becomes very high. Correct? Because investor will say that, see, I am undertaking a higher level of risk. I should be paid higher return to compensate for that higher risk. Okay, students? Yes. Yes. Now we discuss, students, that there is a pool of assets, which is a portfolio of loan. Now let's understand from the portfolio perspective, there is a risk and there is a return. Similarly, that portfolio risk and return will be dependent on the individual loans, risk and returns. Let's say A, B, C is what we have given as a loan, different loans. Their individual risk return profiles will actually affect the overall portfolio risk and return. Yes. Now let's come to some of the commercial part, students. Now, see, if you see borrower, originator, and SPV are three primary parties to the securitization process, and even investor for that matter. So now SPV and investor are not working for free. They also need some commission, or they also need some of the earnings, right? How they will get? So let's say borrower is supposed to pay to originator as 10%. I'm talking about, let's say, interest. Let's take an example of interest. Now, what originator will pay to SPV is only 9%. 1% originator will keep it with themselves. Then SPV will pay to investors around 8%. So 1% SPV will keep to fund out, to manage the fund expenses, right? That they are incurring, students. Correct? Now, let's come to the different types of instruments that are used under the securitization process, students. The securitization process is clear till now, right? Or there are any other questions or queries, students? Please do let me know. Otherwise, we will move ahead to the securitization instruments. I think it's a relatively easier topic. Yes, Prerna. Prerna is saying all clear. Okay. Okay. So Abrikesh is asking, in real life, if there is any example on SVP, SPV, special purpose vehicle. Okay, I'll tell you. See, all of you, I don't know whether you are very young to understand about the 2008 crisis. There was a big crisis that has happened in the US, right? So I'm just giving a very practical example there. Now, what has happened over there is in that crisis, the banks have given loans to the retail borrowers like me. Let's say I've gone to the bank for purchasing a house and bank has granted a loan to me. What they did is for the same property, yes, Prerna has mentioned Lemon Brothers, perfect. So for the same property, which has a value of let's say 50 lakhs, they had given a loan of 75 lakhs, 80 lakhs in the assumption that the prices will go up and the rotation of money will be faster. And what they kept on doing, the banks kept on doing a doing a sale of those assets to those SPVs. And then SPVs had certain investors. And what has happened now, the credit rating agencies should have played a bigger role there. They should have pointed out that the underlying loan itself is at a very high amount compared to the value of the mortgage itself, right? But that has never happened because they wanted the rotation in a very high manner. Hence, what happened ultimately? Ultimately, the investors, funded for 2x or 3x worth of the property. Okay. And suddenly the one part of the chain collapsed, the entire chain collapsed because some of the investors in the SPVs were really these home buyers also. So since they anticipated, that they are investing into a SPV for higher returns, because SPV was also saying that, if the value of the house is 2 to 3 times and the loan is also higher, they were also giving higher returns. Right? They will also give higher returns on a higher loan, higher interest, everything. And the credit rating agencies did nothing. So what happened? Ultimately, they were not able to repay the amount to the bank slash SPV, and they were also not able to realize the amounts from the investments that they did. Okay, so this is the entire thing that has happened. And there were a lot of banks and their respective SPVs were involved. Lehman Brothers is one of them, Merrill Lynch, right? Lot of them were there. So just to increase their business to earn higher commission, they ended up giving higher rotational loans and they used to sell it to a SPV, which they only created, and hence this entire bubble happened. Yes, India are also there many SPVs. I don't know, Abrikesh, specific names of those SPVs, which we can find it on, let's say, internet. Okay. But there are SPVs who are running on the securitization. And there is a complete law also on this securitization and reconstructions of financial assets, right? Which we call as Surfaces Act, which you will be studying in your law part, I think. Okay. Now let's come back to the securitization instruments. There are different kinds of securitization instruments, students. SPV is issuing those to the investors. What are they? One is the pass-through certificates. As the name suggests, whenever we say pass-through certificates, that means it is passing through. Whatever is coming, it is passing through. Coming from whom? Coming from originator or coming from borrower. The income to SPV will come from originator or borrower, right? That SP will pass it through to the investors. Pay through securities means that securities have been issued, but it will be paid according to the terms and conditions of the securities. And there are stripped securities, which we will discuss. So let's discuss these in detail. Yes, so this was an important discussion. Yeah, students. So we said that for equity, the underlying is business actually, right? Because whatever you earn in your equity, your business is performing or overperforming, underperforming or overperforming, right? That is where your business becomes your underlying of equity. For debt, it's the cash flow generation becomes your underlying for debt. Many derivatives we will discuss in our next sessions to come, and mortgage backed securities, we have mortgage loans, students. Now, students, let's discuss in detail what are these pass-through certificates. Okay, let's take three different cases. In the first case, borrower is paying 100 of principal, 50 of interest, and 150 of prepayment. In totality, 300 rupees borrower is paying to back to SPV, students. Now, what will SPV do? SPV will also give this entire 300 proportionately to the investors. It will not hold anything. It will just pay it. In the second case, borrower pays only 100 of principal and 50 of interest. That's all, 150. In this case also, SPV will pay exactly 150 proportionately to the investors. It will not hold back anything, students. You understand, this is called as pass through. Whatever is coming in, it is passing through. Whether it is higher, passing through, lower, passing through. Let's say borrower in the third case defaulted and it has not given 80 rupees which was due. Then SPV also will not pay anything to the investor. That 80 rupees loss is also there to the investor, students, by not giving anything. Let's understand pay through security, students. So pay through securities, again, we will take all the three examples, all the three cases that we have just seen. First one, borrower is actually paying 100 for principal, 50 for interest, and 150 it is prepaying. Now, pay through securities have committed to the borrowers that they will always pay 200 rupees. Okay. Irrespective of whatever is the cash flow for this SPV, they will end up paying 200 rupees as per the terms of the security that is issued. Now, in the first case, SPV receives 300, but what is the obligation of SPV to pay to the investors? Only 200. So it will do for what balance 100 rupees, it will invest it. Okay, it will invest it. Similarly, in the second case, it receives 150, 150 in totality. How much SPV has to pay to the investor? 200 rupees, right, students? So in case this 200 rupees is to be paid, what is the income? 150, payment is 200. Negative 50 is somewhere it has to arrange. It will arrange from the case 1. Whatever it has surplus invested, it will use that to repay back the another balance 50 to the investors, so that the outflow to those investors is kept at 200 bucks. However, in the pass-through certificates, whatever was coming, whether higher, lower, it was going to the investors. Then the third part. Third part is where the borrower actually defaults to SPV by rupees 80. Then SPV has to pay to the investor again 200. Now, out of that 200, 50 it has the previous investment, right? Previous investment in case 1 was 100. Out of that 50 it has paid in case 2. Now balance is 50 in the case 3. So that 50 it will use. Balance 150 it will have to borrow and pay, students. It has no other option but it has to borrow and pay. Clear, students? So I hope now the difference between pass-through securities and pass-through certificates and pay-through securities is clear. PTC and PTS And it's very clear. Pay through securities is very much independent. Pass through certificates is totally, it's a complete proportion of what is being invested there. Is it okay, students? No, Brikesh. See, borrower is not paying anything. I mean, that's the practicality of it, right? It can happen. Borrower defaults. Borrower is not having the paying capability, right, to pay it back, and hence borrower's defaults will be made good either by SPV or by bank, right? As we discussed about the recourse and non-recourse basis, correct? Now, this is the theory on PTC and PTS. Cash flows of the investors would be linked directly to the cash flows of the mortgage held by the SPV. That is called as the pass-through security, students. And pass-through certificate, sorry. And pay-through securities is cash flows of the investors is not linked directly to the cash flows of the mortgage loan held by the SPV. Surplus can be invested by SPV or deficit can be borrowed by SPV. Okay. So in case of PTS, the investor and SPV will agree to a payment plan independent of the mortgage cash flow, students. Correct. And in this case, the desynchronization happens of PTS, which is cash flows to be paid to the investors and cash flows to be received from the investor, students. Okay, students. There's a complete desynchronization that has happened. That is what the essence of this pay through security is. Okay. Okay, let's see the difference. Pass-through certificates, prepayment would also be for the investor. Pay-through securities, prepayment would not impact return for investors. This will be invested by the SPV itself. For PTC, no stability in return or spikes. And PTS, it's a stable return or a stable cash flow. Now let's discuss the stripped securities, students. So in case of stripped securities, we understand that a cash flow that is coming on account of a loan has two components. One is interest and second one is principal. So where interest is there, so stripped securities, what happens? It will strip the entire cash flow into two parts. One is the interest part and second one in the principal part. So let's say in totality, 150 is what we are receiving. Out of that, 50 is interest and 100 is principal. Interest is called as interest only, principal is called as principal only security. And SPV will actually have two different types of securities. One is principal only and second one is interest only. And in interest only will be lesser than the principal only because interest only has a lower amount. And as we know, students, that the prices are inversely related to the interests. If interest goes up, prices goes down, right? So now how will that have an impact on IO and PO respectively? So let's say 10% is our base percentage. It has moved up to 12%. The market interest rate has moved by 2% higher. In case of interest only, what it will happen is 50 rupees is the interest amount will get multiplied by 12 divided by 10. So it will become higher, right? Sorry. It will become higher, right? The moment interest increases, the interest only amount will be higher. Clear? And in case of principal only, the moment interest rate increases, the price will become lower. The simple reason that the prices are inversely relation to the interest rates for the principal amount. Similarly, if the interest goes down to 8%, then also the same thing will hold true. And here also the inverse thing will hold true, students. Okay, so this is all about the stripped securities where we have a interesting relationship of the interest rates along with the interest only security and the principal only security. Okay. Now this is an example actually, if we have to see once. So let's say there are three different mortgages, mortgage 1, 2, and 3. And pass-through certificates have three different principles, 100 crore, 200 crore, and 200 crore, which is principal in these three different mortgages. Interest is 5%, 5.5%, and 6%, and maturity is 2 years. I think 1 year and 1 year, yes. Yes. And these three loans are converted into different denominations or securitized, right? So what we say is denominations into number of units should be 500 crore, right? Because these are the total cumulative amount. So if we want to calculate that, what is the weighted average mortgage rate? Can we calculate? Yes. If you understand that it is 5%, 5.5%, and 6% for the three mortgages, and what is the respective weights? The respective weights are 100 by 500, 200 by 500, and 200 by 500. Correct? So let's say it comes as 5.6%. Now, out of this 5.6%, 0.6% has to go as a fund cost. For example, we are saying, hence the net pass-through percentage becomes 5%, students. Clear? So whatever you earn, irrespective, 5% will go through a pass-through. So let me check the other query handle if there are some other queries there, students. No. Okay. Then if I may ask you, what is the weighted average maturity? How will you calculate the weighted average maturity? Again, by taking the weights and multiplying by the respective years. This becomes 1.2 years. So SPV would propose to investor a return of 5% with an average maturity of 1.2 years. Correct? Because SPV can pay maximum 5% as a return for a maturity of 1.2 years. That's how the pass-through certificate is calculated. It is not dependent on any risk of, let's say, default that might come in future. Okay. Yes, students. Now, this is an interesting discussion on blockchain and tokenization. Now, I would request all of you to please contribute your thoughts on what do you think a blockchain is. Anything that you think that comes to your mind, because in today's environment, it is very interesting to understand what a blockchain means, right? What is this concept actually? We always keep on, thinking, deliberating, but what is the real basic concept of blockchain? And then we will move to tokenization actually. All if you can answer wherever it suits you, either on this portal or on the query handle. So Abrikesh has replied, no idea. Okay. Prerna. Blockchain is where input can be done from anywhere, but once recorded cannot be changed, I guess. Yes, right now that is true. That is very true. Okay, so let's understand what is a blockchain. First of all, let's you know bifurcate the term of block and chain. What is a block and what is a chain? Chain is actually something that keeps lot of things into sequence, right? And what is that something? That is block. So we have a block and then it is chained to another block, then it is chained to third block, then it is chained to the fourth block, like that. So all these blocks are binded together in the form of a chain. That technology or that mechanism is called as a blockchain. Understood? Now, we need to understand that what is really part of that block. We know that if we put thousands and thousands of blocks into a chain, it is called as a blockchain. But what is that block is storing? That block is storing a lot of information. Okay, let's say we have to send a payment. We are talking here. We have to send $100 from India to Australia. Now we'll see how this will happen in a normal route. In a normal route, India will have an intermediary bank, and that intermediary bank for India will also have a tie-up with another intermediary bank of US. And that US intermediary bank will have a tie-up of an intermediary bank with the Australian company that the account is holding, right? So what they will do for ease of reference, I have mentioned here I, U for US and A for Australia. So what it will happen is that India company will instruct the intermediary bank I to pay $100 to Australian company's bank, right? Which is A. Now, what this intermediary bank I will say to the intermediary bank U that I have an account with you and A also have an account with you. What you do, you transfer $100 from my account to A's account that is there with you. Then the payment will happen. So what you will do, you will transfer $100 from I's bank account held in U to the A's bank account held in U. Clear? Any questions? This is a very easy and conventional method of paying to the anyone to the outside world and in the mode of US dollars. This mechanism is called as SWIFT. It's called as a SWIFT payment. Okay. Now, let's understand it from a blockchain perspective, students. So first of all, okay, before we go to blockchain, in this process, the common platform was given by intermediary bank U. Yes, Abrikesh, that's what I'm saying. This is the conventional method. That's why this system is in operation since long time. Yes, I'm also saying that. Now let's understand the new part, which is the blockchain part. Hence, I was saying that in this case, the intermediary bank U will actually have accounts of both I and A, and they will keep on transferring the monies as and when they instruct to them between one account to another and another account to third, like that. Now for this common platform, so there is a big network that is there. Okay, in that there are already different blocks. So in one of the block, it will be encoded, it will be coded or written such that India is equal to $100 So India to Australia is equal to $100 in their own language. And then after that, India's balance will be $1,000 and Australia balance will be $1,100. And there will be a unique number assigned to this block. Okay. And basis this entire thing, someone will enter the data, then it will be published, it will be verified and authenticated in the network, and then it will be added to the chain. Chain of what? Block 1, block 2, block 3, block 4, and block 5. There is a blockchain. Now, if someone wants to change block 2, for that, a new block will get added. So, original information will remain as is. So, what are the key features, students? One is it is a decentralized database. Anyone can enter the data at the same point of time. You would have heard of working on a shared workbook in Excel. In that, multiple people are updating the data at the same time. And hence it is decentralized, open to be viewed for both India and Australia. It can be viewed by the respective people. And the data entry happens in an encrypted manner, and it is also stored in an encrypted manner, students. Clear? So we call this as a decentralized database because it is edited by multiple person on the platform at one go. Yeah. Then data entry to block is initiated. Now this is the process. Okay. First of all, someone will initiate the data entry to the block. Then second is block is broadcasted on the network. Okay. Once the data entry is happened, then that block will be made visible to the people who are there on the network. Now that network will validate such blocks using cryptography. Now there are specific professionals or specific consultants who will do that validation. Then it is represented online as a block. Once it is validated using cryptography, it will be represented online as a block. Then it is added to the existing chain of the blocks, and then transaction is deemed to be complete. So this is the entire technology that is happening behind the blockchain. Then there is something to know around the applications of blockchain, where all it can be used, students. So let's talk about a financial services, wherein we have lots and lots of data, and that data is linked in the form of, let's say, credit cards, in the form of loans, right? So all that can be stored, linked, blocked, used from the blockchain perspective. Second is healthcare. In the case of healthcare, the important documents regarding the reports, the diagnostics, the consultants, uh, the consultant's prescription, everything can be added to that block and kept for that particular patient. Similarly, for governments, if you see, governments also deal with a lot of paperwork from the registration offices, whether it is registrar related to the stamp duty for land and building, all those things can be linked using the blockchains under the government tab. Then travel industry, students. Travel industry, as we all know, lot of documents needs to be added. For example, passport, your personal identity, right? All those things can use blockchain, right, to have that information ready and hence to avoid sufficient hassles. Then any sort of the economic forecasts. How will GDP perform, right? Because for that also you need a lot of information to be processed. Now, what is tokenization, students? Tokenization is actually process of converting tangible and intangible assets into blockchain tokens. Sorry. So in this, let's say we have a piece of any artist. For example, we have some big painting, right? That is a tangible asset. It can be converted into a blockchain token, and then that token can be dealt in. It can be traded off, right? So in a way, what you have done, you have actually converted that tangible or intangible asset, which was not really a liquid one, to a marketable security in the form of a token. And hence it is called as tokenization, which is very much similar to the securitization part. I think this is a very brief on the securitization piece. Wait, let me go to the MCQs. Yes, Abrikesh, Bitcoins are also an example of blockchain technology. Okay. Now, students, let me ask all of you these questions, right? I will give sufficient time. These are some of the MCQs that are drafted on these two topics, portfolio management as well as the securitization bit, right? And you can answer, let's say, one after mentioning the question, 1A, 1B, 1C, like that, right? I request everyone to please attempt it so that, we come to know whether it is entirely successful or not. Okay. So let's stay on question number 1, and I will also flash what is the correct answer. So question number 1, it says that which of the following risk is an unsystematic risk? Interest rate risk, market risk, purchasing power risk, or financial risk, students? Please be very careful while you answer. You can either answer on the question handle or directly on the chat box of the Zoom, wherever you feel it is okay. I will not reveal the answer and I will not repeat the answers that are given by you. I will just say it after, let's say, giving some time so that all of you can answer. So we are on the first question, students, as of now. Which of the following risk is an unsystematic risk? And with this, we should actually understand what was unsystematic risk. Unsystematic risk is something which is a risk for the entire, which is a specific risk for a specific company. It's not a general risk. It's not a risk for the entire organization, entire economy, right? So yeah, students, come on. Question number 1, whether A, B, C, or D, what is the right answer? Very good. I'm receiving answers. Okay, Abrikesh has went to question number 3. Okay, let's wait, Abrikesh. Let's be at the pace of the entire session. I'm still waiting for others to respond. I have not got responses from all of you students. Prerna has replied. Abrikesh has replied. Rolina and Viraj. I request you guys also to respond. And I think Munish has replied on the query handle earlier. I request Manish, if you are still there, to please record your response. Yes, Rolina has replied. Perfect. Then Viraj. Okay, Viraj has also replied. Perfect. Manish, if you are there, you want to revert? Let's wait for another 10 seconds if the revert comes. Otherwise, let's move ahead. So I think for first question itself, there are mixed answers, I can tell you. Okay. Some of you are correct and some of you are not. But nevertheless, please again read the question very carefully. It says that which of the following risk is a unsystematic risk? What we have studied, interest rate risk, is it a systematic risk or an unsystematic risk? Come on, students, tell me. Between S or U, interest rate risk is systematic or unsystematic? Come on. It is a systematic risk. Market risk, as the name suggests, it is the risk appearing in the market. It is also a systematic risk. Interest rate risk, why I'm saying systematic? Because single change in interest rate will impact the entire market, students. Purchasing power risk, it is also a systematic risk. It's not an unsystematic risk because purchasing power risk is actually inflation. Inflation will impact all the companies, not only a specific company, students. And ultimately, financial risk was what? A unsystematic risk, students. Correct? Financial risk was a unsystematic risk. I hope I'm clear. So the right answer is question number 1, D. So, okay, Viraj. Perfect. Abrakesh was saying S, that is also right. Now let's come to question number 2, students. Dash can be diversified. What can be diversified? Tell me. First of all, what is your general answer? What can you diversify? Can you diversify systematic risk or unsystematic risk? Come on, tell me. Systematic risk can be diversified, okay? No, it's not which is known. Application is saying which is known, okay? See, known are both systematic and unsystematic, both of them are known. My question to you is whether you can diversify a systematic risk or whether you can diversify a unsystematic risk. Come on, tell me, students. Abrikesh is saying systematic. Okay, tell me one thing. Systematic risk from that previous chart that I had shown, I had mentioned, right? If you increase the number of securities, and let's say this is the return. No, sorry, this is the risk. Then the chart looks like this. And we said that unsystematic risk is going down, but still systematic risk will remain. So what are you diversifying here? Systematic or unsystematic? You're diversifying unsystematic risk. So unsystematic risk can be diversified. Now, can we understand that what is the purchasing power risk, business risk, or financial risk, or both business risk and financial risk? What is the right answer? Now tell me, students. I've given you a very big indication. Abrikesh has responded. I request Viraj, Prerna, and Rolina also to reply. Okay, perfect. I'm getting answers now. Wait. So, students, we have studied unsystematic risk also has two parts. One is business risk and second is financial risk. So both these can be diversified. The correct answer is D. Students, please don't hurry up in answering. Please try to understand the question and the correct part accordingly. Okay. Now let's read the third question. Please read. So Abrikesh has responded. This question is saying portfolio of two securities having dash cannot lead to negligible portfolio risk. Portfolio of two securities having dash cannot lead to negligible portfolio risk. One is the perfectly negatively correlated returns. If the portfolio of two securities have perfectly negatively correlated returns, then the portfolio risk will be higher or lower. No, Abrikesh, please understand my question again. If the portfolio of two securities have securities such that both of them are perfectly negatively correlated, then the risk will be lower. The portfolio risk will be lower, right? Because they are perfectly negatively correlated, students. Similarly, Viraj, risk will be lower, okay, not higher. I have asked for the negatively correlated. For perfectly positively correlated, it will always remain higher because it will get added in relation to the proportion, though. Okay. Uncorrelated returns, there can be a possibility it will be negligible. Okay. So the correct answer is, students, come on, tell me now. Third part, what is the correct answer? Which possibility actually rules out that the portfolio risk cannot be a negligible one? What is that possibility that completely rules out? That is what the question is asking you. Yes, Abrikesh, perfect. Viraj, Rolina, very good. You guys are answering now quickly. Very nice. The correct answer is C, students. Because only this possibility cannot lead to a negligible portfolio risk. Might happen that uncorrelated returns also can lead to negligible portfolio risk, right? It might happen. Similarly, perfectly negatively correlated returns it will always happen that it will lead to negligible portfolio risk, right? But C, it will never happen. So that is what was needed, students. Okay, now next one, fourth. So question number 4 is also very good. What is the slope of a capital market line? Is it a Trenner ratio? Is it a Sharpe's ratio? Is it Jensen's alpha or none of the above? Very good, Viraj. Prerna, please recheck once your answer. Rolina, please respond. Abrikesh, question number 4, what do you think is the right answer? So students, we have studied two lines, right? Capital market line and securities market line. Securities market line had beta and capital market line had standard deviation. And Sharpe's ratio uses standard deviation. Trenner's ratio uses beta, right? So what do you think is the right answer? It's Sharpe's ratio. It can never be Jensen's alpha. Because Jensen's alpha is comparing actual return and the expected return. That's all. Trenner's ratio, why it is not there? Because it uses beta. That's why. Had the question been, what is the slope of securities market line? Then it would have been beta altogether. Okay. Now let's go to question number 5, students. Now, yes, this is an interesting one. Sharpe's index model or single index model uses interrelationship of securities within the portfolio, relationship of every security with that of the market, market returns, both relationship of every security with that of the market and market returns. What does it use, students? Question number 5. Come on. So single index model or the Sharpe's index model, we studied, students. It takes two things into account. One is macro and second one is micro. Macro is something related to the market. Micro is related to the unsystematic thing, which is in the form of returns or in the form of risk. Okay, one thing I would request now technical team to please open the session also so that the students can ask verbally or a live question if they want to ask. Okay, Ashok ji? Hello, Ashok ji? Yes, you can enable the session so that if students want to ask the live questions verbally, they can ask. Okay. And I request all the students, in case you have any questions to ask, please do it on the application. by raising your hand or by unmuting you, and you can speak up. Okay. Viraj is saying, okay. Abrikesh has also responded, and Prerna has also responded. Any other, Rolina, you want to respond? Okay, Rolina is saying B. Perfect. So is there is a catch in this question. Although B is the apt answer, however, it is also mentioned as market returns. So Sharpe's index model also uses market returns, right? So hence the correct answer becomes D. Both relationship of every security with that of the market and market returns, students. Yes, students, I think now all of you are open to ask. In case you want to ask, please do ask, students. Okay. So question number 6. Dash indicates higher risk. Higher standard deviation, higher beta, higher variance, all of the above. Very easy question, students. This is all of the above. Correct? Because standard deviation and variance, both of them are risk itself. And higher beta will also denote higher risk. Although it's not equal to risk, but it will denote higher risk or it will indicate higher risk. Okay. Question number 7. Now, these two questions are from the securitization, 7 and 8. Dash entity sells the assets lying in its books and can be termed as securitizer. Very good, Prerna. Very good. Abrikesh. Yes, you are also correct. This is an easier one, students. Viraj and Rolina, you want to respond? Okay. Viraj is saying, Viraj, please recheck if you're asking, if you're telling about the question number 7. It's a bit deviated. Come on, students. Question number 7. Dash entity sells the assets lying in its books and can be termed as securitizer. Okay, Rolina is also saying okay. The point that you can say is that sells the assets lying in its books. In case this securitizer is confusing you, some of you might think since it is securitizer and it is SPB, but it is saying sells the assets. So it is quite clear it is originator. Okay. Then last question, question number 8. Dash allows investors to carry proportional beneficial interest in the assets held in the trust by SPV. Prerna, no. Please recheck your answer. Abrikesh, yes. You're right. Yes, others, please respond. Dash allows investors to carry proportional beneficial interest in the assets held by the trust by SPV. Yes, very good, Viraj. It's yes, very good, Rohan. I was waiting for your answer. It's passed through. Actually, it should be certificates because that is the term that is used. It should be pass-through certificates. Correct? Clear? Now I request anyone who have any questions, please, they can unmute and speak themselves. They can raise their hands, we can unmute, or they also can unmute because this is an opportunity uh, to interact. I request if there are any unresolved queries or questions, please do let me know. Yes, students. Okay, meanwhile, if someone have any query, let's see this question number 16 actually. Okay. And in case anyone has any query, please feel free to, you know, ask up, speak up, raise your hand, unmute yourself. We will be happy to answer that, students. So question number 16, following information is available regarding expected return, standard deviation, and beta of 6 share are available in the stock market. Okay. Expected return they have given, betas they have given, and the standard deviations also they have given to us. Now they say that suppose the risk-free rate of return is 4% and market return is 6%, and the standard deviation is 10%. You are required to compute the following. The standard deviation is 10% of the market. Okay. Which security is undervalued and which security is overvalued? For calculating a under or overvaluation, we need to calculate what is the expected return and what is the actual return. So expected return is already given, right? 5, 10, 11, 12.5. So let's calculate the calculated return. Risk-free rate plus beta into market risk premium. That gives us 5.4, 6.10, 5.9, and 6.2. And similarly, 6.8 and 7.4. So for all the securities, we can use their respective betas and take respective betas and multiply into the risk premiums, right? And compare with them the expected return. So 5.4 against this 5.4, they're getting 5. So this is really an overvalued. We should sell this, right? Because the expectation is, no, wait. My expectation was 5.4, but I'm getting 5, right? And hence I should sell this. Herein my expectation was 6.10, but I'm getting 10. So it's really undervalued, right? Similarly, here my expectation was 5.9. I'm getting 11. I should purchase it. So these are the analogies we can draw. So we know that securities 2 to 6 are undervalued because their required rate of return is lesser than the expected return. Right? Security 1 is overvalued because expected return is less than the required rate of return, which is true. Now in the second part, they're asking us to calculate the portfolio return and risk, students. Now, portfolio return, students, 1/6, 1/6, because there are 6 securities, equal proportion we are investing. So 1/6 into the respective returns. Here we will take the 5, 10, 11, these returns. And it is mentioned here that we equally invested in these 6 stocks, students. Okay, so the portfolio return is this much. Now let's come to the portfolio beta. Sorry, portfolio risk. Now, students, in this, if we apply the matrix model, we have to calculate 36 different numbers and then add them up as per the Markowitz portfolio theory. And for that, the relevant information is also not given, right? What is R? what is covariance, at least those things would have been given. So what we will do is we will actually use the Sharpe's index model. So Sharpe's index model, we first need to calculate what is portfolio beta, students. So portfolio beta will be calculated by multiplying the respective betas into the proportions that we are supposed to invest, students, right? That will give us a portfolio beta of 1.15, right? It's just a simple multiplication weighted average. Now, as per the Sharpe's index model, the variance of a portfolio is weighted average beta square multiplied by standard deviation of market square, respective weight into the residual interest, residual variance. Now, if you see, students, this SD is actually the overall SD, correct? So then our task will be to find the from overall SD, the unsystematic SD. This is the catch in the question that I was telling you. So we have the total variance, right? Again, we have to do the square. Out of that, how much is the systematic risk that is given by, for individual securities we are doing, that is given by beta square into the market deviation square, market standard deviation square, right? So this market standard deviation is 0.10, 0.10, 0.10, these ones. This will give us the systematic risk for that particular security, which is 126. This is the total risk. This is the systematic risk. And this gives the unsystematic risk. So the unsystematic risk is total variance minus systematic risk. This is the unsystematic risk, students. Perfect. Easy. That was the only catch in this question, students. Again, I'm requesting students, if there is anything to ask, please unmute, raise your hand. Please do ask that question here itself. Yeah. So now we have the unsystematic risk or residual variance, whatever you want to say, of these respective. And in that, we have to multiply with the respective weight square, right? Which is 1 by 6 raised to the power 2. This is what we have done here. And then taking a summation of this, so this becomes the portfolio unsystematic risk for the entire portfolio. Okay. Clear, students?
Sir, Abrakesh.
Yes, Abrikesh. Yes.
Sir, in above page, I mean, where you have last column, you have multiply 1 by 6 the whole raised to 2.
Yes.
Yeah. So weight is 1 by 6 or is 1 by 6 multiplied by that 5 and other things we have calculated earlier.
No, 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 no.
Yes.
No, weight is only 1 by 6.
Here. I'm talking about 1 by 6 by 5, for example.
Sorry, where are you referring?
First initial stage, sir, of this sum question.
Acha,
Yeah,
this one. Okay.
yeah. 1 by 6 into 5 you have taken as a weight, no? For portfolio review.
No, this 5, 10, 11, 12.5 is actually the return that is given in the questions to Abrikesh.
Okay.
You see, this is
that I know. Yes. Yes.
okay. But weight is 1 by 6.
Okay.
If you ask me what is the weight, weight is 1 by 6.
Okay.
6 securities, and that we have arrived because it is mentioned that 6 securities are equally.
Yeah. Thank you.
Understood, no? Okay.
Yes,
so
sir.
Here, yeah, perfect, Abrikesh. So here we take 1 by 6 raised to the power 2, right? Because it should be the weight square. That's what the formula is. Weight square into residual variance. That's how we take it. Okay. Okay. Thank you, Abrikesh. Now, I was saying that this is the unsystematic risk. Now let's come to the systematic risk. Systematic risk is the portfolio beta, which is already weighted average beta, right? 1.15 raised to the power 2 multiplied by the market standard deviation square, which is 0.10 square. So this gives an overall value of this much. Now, if you add systematic and unsystematic is coming from here, and take a square root of that, that will give us the portfolio standard deviation. Clear till now? So the portfolio standard deviation is 12.53%. Now, third part. Suppose if the above portfolio is invested in with a margin of 40% and the cost of borrowing is 4%, then what will be the position? Okay, now they're asking us that the portfolio is invested in with a margin of 40%. And they have also told us the cost of borrowing as 4%. Now, students, if you see, what do that really mean? It means that 40% will come from borrowing, and that also you invest in your portfolio. So 1 plus 40% of 1. So in totality, you invest 1.4, and we have taken 0.4 from the borrowing, and hence it is in totality will still be 1 because 0.4 will be minus 0.4. Correct. So I've taken from borrowing and invested in the portfolio. So this is another catch in the question. Now, how will expected return change? My expected return on portfolio, which is 11.58, will get multiplied by 1.4. And 4% what I have to pay will get multiplied by minus 0.40, which is 40%, right? So I will end up having a return of 14.612, which is higher than if I would have not borrowed and invested. If I would have directly invested whatever I had, it would be 11.58. Now, if I borrowed and invested, it becomes higher. Reason being, my borrowed cost of capital is 4% and my investment is happening at 11.58%. Hence, my expected return will increase. And then what is the overall risk now? So here, the risk of borrowing is always 0, students, right? Because the rate is fixed. Everything is fixed, right? So we don't have a risk of this borrowing. Although weight is 0.40, here weight is 1.40. So we'll just simply multiply the risk with this weight to arrive at the risk of the portfolio, students. So students, with this, the revisionary aspects of portfolio management and securitization, along with some of the MCQs to test our understanding, comes to an end. I still ask if there is any other question, students can ask verbally or raise your hands. Apart from this, yes, Viraj, you have raised your hand.
Sir, am I audible?
Yes, you are audible, Viraj.
Sir, can I get the solutions for the questions given?
For the questions that we have given in the recorded session, right?
Yes, in all recorded session, I took the printout of all question, but I want answers. Some
Okay.
of the answers are I will get from attending recorded lectures.
Right.
But so can I get the soft copies?
Sure. I think see Ashish sir is also there with us. Sir, you can hear us? Sir, you are not audible.
Sir,
So Viraj, maybe we will check and come back once. I think there is some issue.
Am I audible now?
Yes, sir, you're audible now. Yes.
Okay.
Now
Okay,
audible.
Viraj, so far as a solution is concerned, we normally encourage a student to go through the lecture and prepare your own solution. Of course, we shall consider your suggestions so that we can host the solutions of the questions. The soft copy will be only the handwritten version only. Okay, so we can, of course, we can get them uploaded. Okay, Devas sir, we shall arrange something.
Sure,
We shall
sir.
get them uploaded.
Sure, sir.
Any more query, please?
Sir, one query from Abrikesh. He's
Okay.
asking any detailed content reference book for these two topics.
Abrikesh, of course, in market there are many books are available. Of course, but see, the coverage of this book is very wide. Okay, from your syllabus point of view, uh, basically, from your syllabus point of view, the coverage is not that much wide. Okay, so from research point of view, of course, there are many books available. But my request to you, if you go through the study material and our ICAI publications already, you will understand all the concepts and even you can attempt the questions in the examination. Because most of the questions you will see, find out from these textbooks, the questions are the same that we have taken in our study material as well as in our assignments. Okay, any more query? Yeah, I think there is one query from Munish Kumar Gupta,
Okay.
and he is saying, what is sir SPV?
Okay. Sure, sir. So SPV is, as we discussed, Manish Kumar Gupta. No. Actually, he has answered that SPV actually. So I was
Okay,
asking
okay,
a question
okay.
whether it is
My
SPV.
mistake.
Huh. So that was SPV. Yeah.
Okay. Because I thought he must have. I have just joined the
Right to
session.
ask. Yeah. No,
Yeah,
sir.
yeah.
Yeah.
Okay, students. So I think there is no more queries. Okay, student. We hope the today's topic that has been covered. I think you must. It must have been must very clear to you now. In case you still have any doubt, you can contact us over the or, through the mobile app, or you can send us the email, and you can also contact over the telephone. Devas sir, just do
Yes.
a favor for us.
Sure, sir.
Just write down the our email ID.
Yes, sir.
SFM SFM dash final @ ICAI.in. Okay, student. Or you can contact us as 0120 3045 956. Okay, student. With this, we come to the end of this today's session, and we shall come in the next session where the next topic will be taken up first. Same, we shall take some revision. Then, of course, after that, we shall take up your queries. Okay, student. With this, we end up this today's session, and thanks
Sorry,
for
sir.
patience.
Sorry, there is one query just now I have received
Yeah,
on the Zoom application from Prerna, where
yeah.
one request, we are revising all topics with lectures and MTP and RTP are available, but if we can have test for some chapters in mid of the batch so that we can analyze how we are performing before going for MTP and
Okay.
RTP final examination.
So, you want Prerna beta, you want chapter wise test basically.
Yes, she's
Yes.
asking.
Okay, it's a very good suggestion. Of course, we will work on that. Don't worry. From the next class onward, we will host one more test also. Okay, so that student can they can evaluate their own performance. Okay, Prerna, take your session is very good. The session is taken. Okay, student. Now, Devas sir, thanks a lot for your sparing your precious time and enlightening the student on these two
Thank
very
you.
important topic, not
Thank
from examination point of view, but from the practical point of view, because nowadays securitization is becoming one of the more popular product
Yes,
among
sir.
the companies because it is a dynamic product. So now so that's why its practical importance has increased manifold. Okay,
Sure.
students, thanks a lot and have a nice day. Thanks, Devas
Thank
sir.
you.
Thanks a lot.
Thank
Thanks a lot.
you, Sir.
Thank you.
Ashokji, thank you.